Good morning, traders and investors. Thanks for tuning in to Pre-Market Prep with StockOdds. Let's take a look at the S&P futures here. We gapped down this morning and we already filled the gap up to about 4160 or that right around that area. But we're currently sitting down about 0.5% at 4157.50. Let's check out the dollar. We're down 0.2% at 101.43. The bonds up about 0.5% at 130.11. Crude, that's down 2.4% at 77.34. The charts won't load, but we'll keep going here. Gold, that's up 0.2% at 2011. And then silver, that's down 0.6% at 25.19. And Bitcoin, that's down almost 2% at 28,703. All right, Rob, how are you doing this morning?
Too bad, thank you.
Did you happen to catch that rocket launch, by the way?
Yeah.
Yeah.
Looks like it went up in flames on 420.
Yeah. Yeah, exactly. Yeah, it was quite the excitement. Anyway, what do you have in store for us today?
Yeah, kind of ironies, right?
Yeah.
Anyway, but yeah, made it up 33 kilometers, so that wasn't too bad.
Yeah, not too bad at all.
I just think it's funny, these things, these type of ironies. But anyway, we got some things to chat about. So in keeping with Elon Musk's activities, you've got Tesla had some earnings, right? And
Yep.
so we had Tesla. Interestingly enough, let me show my screen here because
Yep.
I will
yeah, they're on a big gap down, that's for sure.
Yeah, so it's worth talking about today. Besides, it's very widely traded, right?
Mm-hmm. Yeah, it has a
So
lot of volume for sure.
on my screen here is the subscriber list that were published for today for open to close. This is the S&P 500 here and the NASDAQ 100. So you notice that Tesla is actually in both of them. Now, you know, people can go and vet things, and that's always sort of discretionary, right? Because you don't know for sure. I mean, there might be some news feeds and analysts and things that you can have some confidence in, perhaps, and get some, secondary handicapping besides the handicapping you do. But but we have our statistics, and you gotta think about what time frame you're trading in as well. Like, it's a lot different if you were swing trading Tesla, and it's going to have an announcement, it's going to have news, it's going to have earnings, whatever. It could even be a situation where there's sympathy to something else.
But it's an event or a catalyst that'll
yeah, like
shake
if you're coming into that, you might say, well, there's a lot of risk in the overnight, right? And then that's where the risks are that are beyond your control. During the day, generally things are more in your control. I mean, you can still have a surprise, you can still have a stock halted and then something come out, but generally speaking, because most major news and earnings announcements are pre-market or after hours, there's sort of the day session is left pretty much undisturbed, other than all the macro events going on and Fed speak, yakin, and whatever else, right? So you have a lot more. I think you have a lot more control during the day than you do overnight. So the caution is, when you're swing trading, are there things on the horizon that you need to be aware of?
Mm-hmm.
If you're trading open to close, you have to put on your open to close hat. It's a different hat. Mm-hmm. Why is it a different hat? Because the thing that an investor might go, oh, there's news, I think I'm gonna unload at the open, I'm going to get out of this problem. I mean, why did Tesla gap down? Obviously somebody wants to sell. It doesn't go there on its own, right?
Mhm.
In order for it to be opening down, somebody has to set a market, right? There's still an auction market. Somebody has to say, I want to sell a whole bunch. And other people go, well, I want to buy. And I mean, think of
Yeah.
it, it's like an auction, right? It's
Mhm.
like, it's supply and demand. So if it's opening down significantly, so let's just
Yep.
go to that
More
chart. I just
sellers
wanted to
than
point out
buyers.
that Tesla was in both of the lists here with positive odds and average performance expectations for today, open to close. Okay. Now, yes, we have an
Yeah,
event.
that's the key, is open to close. Yeah.
Right. So we have an event, and it could end up down even lower. I mean, it may fail because of the catalyst. Okay. It may end up below today's open by the end of the day. I have no problem with that. That doesn't mean anything's wrong with our odds, because obviously news came into the situation. It's not just statistics, but there was a couple of clues that we opened our pre-market. We were sliding down. We hit a low, and we started to build before the open. So it kind of reached its threshold there of like that balance between sellers and buyers, and people were starting to say, yeah, this is a pretty good discount. I mean, you've got a pretty big cult following. you've got a pretty big
Yeah.
like appetite for this stock. I mean, imagine how many Tesla lovers have just been waiting for a good discount so they can get back in, or get into it
Yeah,
again, or whatever. I mean, it
absolutely.
had a good run, and now you get a discount again. Let's just put it on the daily for a moment and say,
Mhm.
okay, it had a good run. Maybe some people sold and are waiting for a dip. We had a pullback here, and it rallied. And strangely enough, we're sitting right down at that low that we had on March 13th. So again, you could say that might be a support number. It might be. Does it? It's close to this low that we had in November as well. So perhaps it's I mean, Joel could probably read the tea leaves on this better than you or I, but
Mhm.
perhaps it's a support level. So you might have some interest from that on a technical basis. You're going to have the people that go, well, this is just a great discount. You're going to have the stock odds people that go, well, it's on both my lists, or whatever, I better buy it, right?
Yeah.
So if I'm not, I mean, that's your choice. You can vet or not vet. It's up to you. Some might say, I'm just going to stay away from it. That's fine. I have no problem with that. Some people say, I'm just going to take whatever's there. And by the way, that compilation that you did for the blog about the 0.1%,
Right.
um,
Yeah, for the
that
top 10.
that has
Yeah.
been something that we've governed ourselves by. Well, I can go back to 1992. Were you even born back then?
I was alive in
Well, that's good.
1992. Yeah.
That's good. That's good, Joel, because
Yeah.
yeah, I'm going way back working with professional traders, and strangely enough, the benchmarks through all these years, through all kinds of markets, have been a penny a share. So the more shares you can trade, there's a rate of production. Earning about a penny a share has been pretty common over the years. If you're trading pairs, like you've got a portfolio of pairs, you're trying to make about an ATR a week. That would be a benchmark. So if it's an ATR on the pair, let's say it's maybe Chevron versus ConocoPhillips or something, and it moves around $1 a day. It does a little bit more than that, but let's say it moves $1 a day. Then on average, you would want to make $1 a week from that relationship. So you're not trying to make, just because it moves $1 a day, it's impossible to accurately take out of the market $1 a day.
Yeah.
That's its
Yeah. You're never
volatility,
gonna
but
hit the
you're
high
not going to be
or hit the
perfect.
low. Yeah.
Right. So it might take you 5 days to make an ATR, based on 10 trades, some of them winning, some of them losing. But to actually earn an ATR would be about a week. And so that's one benchmark. And then the other one is 0.1% return on capital for sort of long short basket trading.
Yeah, per
And that
day.
point per day,
Yeah.
0.1. So if you use $1 million, you should make about $1,000, right? That's kind of the benchmarks that have been there. Now, I know that there's nothing when we publish 0.1% return on capital, there's nothing sexy about that. There's nothing that sort of Wall Street bets leaps off the page and says, I can make 10x on my money today. There's something that's not attractive in that. But let's just think about for a minute. There's a lot of sexy discretionary businesses that weren't able to operate during the lockdowns, COVID lockdowns, correct?
Yeah. Yeah.
Okay. There's a lot of other sexy discretionary businesses that one can get into. People love to they're sort of attracted to these types of opportunities.
Yeah. Yeah. Zoom
But
sure was one that to take off.
well, sure, and there's a good use case for it, and it really was helpful during the stay home economy situation, and it still continues to be. But there's a difference between a utility type business that's boring and has no curb appeal, right? But
Mhm.
those just keep plodding along, and the owners of those businesses make cash flow. That's kind of like the argument of being in some dividend paying stocks and have that constant quarterly cash flow, right? So there's businesses that people aren't attracted to because they're boring and they don't have a lot of instant gratification, instant returns. But those are probably some of the most successful businesses on the planet over the long sample. People
Mhm.
chase growth, but they don't understand there's a dark side to it, and that's when things fail, like they miss earnings or they miss expectations of any sort, and
Mhm.
it gets a 50% haircut sometimes. I've seen it before.
Yeah. Or when
Right.
interest rates rise. Yeah.
Right. I can remember Crocs back in the day, plastic shoes, the big appeal, right? uh Missed earnings one day, 50% haircut. How would you like to be in a stock that loses 50% in a day, right?
Yeah. No
um
kidding. Mhm.
so the argument was, well, anybody can make plastic shoes. So the point is that there's things that are not sexy and appealing for the greed element, but there can be a lot of opportunity in that systematic framework, that systematic process of running a utility type of business and earning money. So the 0.1% return on capital benchmark is that goal, that we have that baseline that we can operate from. And I'll tell you, it's a lot. If I can get a trader to live in that baseline day after day after day after day, and then start to make very slight attempts and this is very sort of incremental, make these steps to increase above that. So one of the comments from one of my traders today was, I think on some of these Russell stocks, I can just go long, right? I can just go long and maybe not hedge right away. Okay. Well,
Mhm.
if you're right on that, what can happen? You might exceed that hedged benchmark. If
Yeah.
you're
Yeah. It'll
wrong,
probably.
if you're
Mhm.
wrong, you could suffer. So it's an incremental growth process. It's like you don't pick up a guitar and learn to play it as a master, in one day or 2 days.
Mhm.
Maybe somebody could, but I don't think it's very often that happens. It's more the 10,000 hour rule of becoming a master at something, right?
Hmm.
So
Yeah, I know for myself, if you had one day where somehow your portfolio went up 10%, let's say, and then the next day it went down by 9.9% a day, even if that averages out to 0.1% a day, those swings are just they're unreliable, and it's having volatility in your own portfolio is can bring a lot of emotions, and then you can start making irrational decisions. And so yeah, it's definitely that boring is beautiful approach with the 0.1% that's beneficial.
yeah, I mean, Joel, I mean, not Joel, sorry,
Yeah, young Joel.
Josh, you guys
Ja-
still start with J here.
I know, yeah.
So I I feel like I pound that all the time, but I know that it's not an appealing argument for many people. I mean, it's so easy to default to a lottery mentality. It's so easy to default to, I've got to really pound it out and make myself 10 grand today, when normally maybe you've only been living at about $200 a day, and now you're going to try to make 10 grand or something. That's where people often go to, especially if they have needs, if they have been down and they're trying to get it back. But you got to let all that go, get rid of the monkey that's chirping on your shoulder all the time, yakking at you, and just develop a nice baseline that you can mature in and start to, do better, right? So,
Mhm.
so Tesla this morning, obviously it had odds to be successful from open to close, but it had a massive discount because of news. So, do you still go in it? It's your choice. I can't say that it always is the case, but you got to look at the context. I think part of the context is, where is it actually opening? You can see it. There was enough trading pre-market for you to know what area it was opening in. That's one part of it.
Mhm.
Two is, you got to look at, you know, who tends to look at these discounts on Tesla as an opportunity, and could it bounce? And I think there was a pretty good argument for Tesla to say, I can do an if then statement on it, which means I can participate at the open. And if it breaks that March 13th low, I'm going to be out. I mean, I think that was a good enough argument, you could say, because there's a lot of air pocket downside to it if it doesn't hold at this level, right? So, but
Yeah.
you could give it that opportunity. The other option is, rather than go full position on something, you could go half position, and you could add to it if it's working. But
Mhm.
anyway, it gave you the bounce, and historically, that first 20 to 30 minutes is where a lot of professional traders have made their money,
Yeah.
not necessarily even holding all day. You can do an open to close strategy, but you could be out of it in half an hour. This happens
Hmm.
quite frequently. I've got traders that are subscribing to our list that say, hey, that was a good morning, I went flat 30 minutes in. Hey, if you get that big pop up to 0.4, 0.5, 0.6% return on capital, which exceeds the benchmark, and you've got your whole day ahead, what's the odds of it might build another 0.10, or 0.2 maybe at the most, but it could also retrace, and then you give
Hmm.
back the profits. So some find it beneficial that if they're having an outlier performance early, just to lock the profit.
Yep.
Now, maturity would have you either do it systematically if you can, or use the market. If the market's rallying, then it might be better to get out of your shorts and let the longs continue to run, right? Which you open up more risk at the moment, but you might be able to use the market. The market's selling off, dump your longs, and just highlight them, blow them out at the market, and then let your shorts slide a bit farther. So there's an opportunity there to use the market to your advantage. Um, so anyway, I want to move on to UUP. The US dollar had a run yesterday up, which knocked basic materials down substantially. Okay. So they're very sensitive. Metals, especially, are very sensitive and metal related
Yep.
stocks,
Mhm.
very sensitive to the US dollar. So yesterday we had it up and the whole group was down. Okay. And then today we saw the dollar have a little bit of volatility pre-market, but was sliding down for the open. And so UUP is our share. We can use that to watch it too, or there's other versions of it. But anyway, we're moving down. And so Alcoa was in our, this is our list here for the Russell 2000 symbols. And Alcoa was gapping down 3.28%. From the open now, it's up 2%. But you can see
It's
what
going to fill
happened
the
here.
gap.
You can see how
Oh,
it
yeah.
filled the gap right away. And
Mhm.
again, in literally 10 minutes. So the peak, peak performance came in just after 10:30 here. And then it's been sliding since. But the point was, it was on the Russell 2000 list. It was opening down with the other, impact of everything else kind of opening down. So there's an opportunity to buy it and hedge, or buy it naked if you want. But the thing that is even more important than that is, if it's opening down with the general market, is there a driver? Is there a catalyst for it that could help it improve from the open? Well, you have StockOdds already gave you some statistical framework for today, open to close. Again, open to close.
Yep.
Right. And now you have the dollar softening, which can help put a floor under it or take the lid off of it. So you have to watch for this. You have to watch for groups and symbols that are opening down, which is general sympathy to the market, but might have their own catalysts, their own benefits, a reason for you to profit from that open discount to whatever, whether you take it intraday or whether you hold it to the close. Now, it could give it back and be down, but it gave you the opportunity. And so there's that argument for improving on the baseline. So the blog that you published is the baseline approach.
Yeah.
Symbols that are
0.1% a day. Yeah.
yeah, symbols that are statistically generated,
Mhm.
not vetted, not traded, just open the close holding. But can the trader improve on that? See,
Mhm.
if you invest in property, you want some upside. If you invest in the stock market as an investor, you want some upside long term.
Yeah,
Doesn't have to be
generally.
today. It doesn't have to be today, but you want it long term. You want upside. You want
Mhm.
capital gains. You want growth. You want to make money. Okay. So that's the context behind this, is that I'm giving you a baseline, which is, call it computer generated, algorithmic baseline.
Yep.
Can you improve on that? Is there the potential to improve on it? And the answer is yes. Is it easy? No. Right?
I
Takes
know.
effort, takes work. It's not easy, but you can improve.
Yeah.
You can
Yeah.
do better
So
than that.
for like a Alcoa, let's say, it still closes, at 40.53 here. You'd be trading it open to close, and you would have still, made a bit of that money, but the improvement comes in at maybe looking at the gap and looking at your levels, and then seeing that it reached that $42 area, and maybe you sold the whole position, maybe you sell some. That's is that an example of that improvement that you're
Well,
talking
sure,
about?
sure. I mean, like, base everything on annualized return. Okay, that's a weird concept when you're day trading, to think about annualized return, right?
Mhm.
But if I was putting a merger on and say it had 9 months to close, and I was going to make about 4 or 5% on that trade, if I got that in one day, wouldn't I take it? Let's just say there was an anomaly, there was some supply and demand anomaly, there was some kind of news, whatever, and I got the 4 or 5% in one day on this merger that was normally going to take 9 months to close for that 4 to 5%, right?
Mhm.
And I got it in one day. Wouldn't I take it and be done with it?
Yeah.
Okay. So
Yeah.
if my annualized, if my expectation on Alcoa is, half of 1% for the day, and it's exceeding that, well, the half of 1% would be the average performance expected because of all the samples that we have. If we go, if you go into StockOdds and you look at the number of samples, like with Tesla, there were 76 events. We had a positive expectation for today. In the past, there's 76 events here that have happened that are preceding today. So this is from yesterday for today's expectation. So you've got a lot of events there, right? It's not just one, right? That's why you have a Sharpe ratio and so on. You have a lot of events that have gone into determining what that opportunity is for the next day. So in the case of Alcoa, that average is still going to be relatively small compared to how it performs on a really good day. And so, it is performing. But look what happened. It literally filled that gap in 5-6 minutes. Okay. So it filled the gap in 6 minutes. And that return there, if somebody had locked the position on a gap fill, I would not fault them for it. But I would make this
Mhm.
suggestion. Okay. This is the suggestion. If it reaches a gap fill, as a percentage of ATR, the ATR is $1.83. So we take even 10% of that at 18 cents, right?
Mhm.
If it hits a target, give it that 10% of an ATR to say, prove it to me that you can't go higher. Prove it to me that you're done. Prove it to me. Prove it to me. Prove it to me.
Mhm.
Right? Don't be nervous, Nelly, skittish, without conviction. Okay. Prove it to me. So it hit a gap fill. Can you go higher? I'm listening. I'm watching. Prove it to
Mhm.
me.
Well, yeah, you also
And
talk about a lot of how it's not just if a stock reaches a level, but it's how it gets there. And yeah, as you say, it got there in
look
a
at
few
look
minutes.
at the signal to noise ratio, right? I mean, it's just
Yeah.
straight up. So obviously it's benefiting from the fact that it had some curb appeal at a nice discount on a day that the dollar was dropping after the previous day. So it has some curb appeal. So people gobbled it up pretty quickly, right? And it filled the gap with high signal. So you owe it to yourself. You owe it to yourself. You're in it from the open. You're in a position, you have value at risk. You owe it to yourself to say, give me all you can give me. I'm not taking this off until you prove it. Right. So
Mhm.
at this point, you could have stayed with it. Went up, tested it. Okay, well, it still hasn't broken down. Went up again, you know, dropped suddenly. Probably wouldn't have even been able to make a decision that quick anyway. Dropped quickly, tested again, bounced back up. So okay, we're still okay. We're still okay. And then it starts rolling over here, and it makes a lower high, and you're not getting that volatility anymore. And so you might say, okay, we've reached that 10 o'clock transition time. Now we're at 10:30. Things are starting to soften. I'm going to close it. So that might have
Mhm.
been the natural progression of your giving it time, having a conversation with Alcoa, right? Hey, what you doing out there? And just
Yeah.
giving it time and being very rational about it, right? But again, had somebody closed it here, I wouldn't fault them. If they saw this turn and it was dropping, I wouldn't fault them. You have to be really reasonable with all the different inputs and stresses, and other people have other positions on and so on. So you can't give it your full-time attention. But just remember, when you look at your P&L, you're going to see things that leap out at you. If you had bought Alcoa at the open, in 3 minutes or 6 minutes, you would have seen some green, some pretty good green, right?
Mhm.
It would have been glaringly green. So does not your attention go to those things and say, I want to make sure I protect that profit? Now I can hold it to the close, or I can look at it in terms of annualized return. This amount of performance in a few minutes versus holding all day,
Mhm.
right?
Yeah,
Annualized
making
return
more
means
use of your money
annual
and
return, but just think
yeah.
we're compressed into one day. So if this thing pays me a full days of wages, this is like some union employees out there, maybe it pays me a full days of wages for 6 minutes. Uh, you know, I'm
Yeah,
good with that.
it's worth it.
I'm
Yeah.
good.
Hmm.
Anyway, I hope that helps. I mean, it's part of what we have to do to get over the baseline too, because imagine that it closed around here. It would still be a gain from open to close, but you would have missed peak performance. So the goal is the baseline plus opportunity for peak performance. Let's grow together in this. That's what we want as a community, is to grow together in this achieving peak performance.
Hmm. Yeah,
Okay.
exactly. Yeah. Yeah. Do you
All
want to
right.
put up that blog just for a sec? So, people can go check it out on mystockodds.com, and it has yeah, a bunch of good info there, and it catalogs at least yeah, the top 10 from the S&P, that list.
Yeah, this is
And
just the S&P list, right? Yeah.
yeah.
Um, but anyway, it's and you should read the assumptions, because that shows you how limited this approach is. It's just statistical, deploying at the open and the close without any fancy stuff. So that's really what this baseline is.
Yeah.
So I think that's important to read all that. I know people don't like to read much; they just read the headlines. What they want to just read this
Yeah.
headline. But you gotta get
Exactly.
into the weeds and
Yeah,
read the
those
notes and assumptions too, because that's very important.
yeah, those are all those improvements that, take you beyond the 0.1%.
Well, I mean, first of all, it lists the what's actually happened. So, right, it's a single strategy of equal quantity of longs and shorts. A trader's goal is to add more strategies. So it's a single strategy, right? And that has its limitations. I mean, it might run cold at some point in the future. But if you have more strategies, your variance could get lowered. But also an equal quantity of longs and shorts, that's not necessarily ideal either. You might on a day might want 30 longs and only 10 shorts,
Hmm.
right?
Yep.
So there's a lot of things that are like handicapped here. It's kind of like, you know, maybe maybe if you're playing blackjack, if the casino has to stand on 17, you still, maybe its basic strategy says for you to stand on 17, but you could elect to hit. You have that option. So my point is that there is a basic strategy, a baseline approach, but you as the human have the ability to improve on that in a lot of areas.
Yep.
So anyway, good job there, Josh, on producing this. I appreciate that. It's nice. So
Oh, yeah.
hopefully people read it and look at it. But that's really the message, is that you have to have a stable condition as a utility type of a business, as a trader, so that you can develop a pro forma of your expected returns, and then go along and see how well you're doing against that pro forma and see if you can improve on that. And when I suggest improving, I mean incremental, very small baby steps, right? So that you don't knock yourself back, a couple months worth of work. Okay. Makes sense?
Exactly. Makes sense. All right. Thanks, Rob, for all that good stuff. And people can also check out the link in the description for this blog. And what's probably exciting for those of you who tune in regularly is next week I'll actually be showing I have an account that's trading some of these lists. So we'll be showing that live, which is very exciting. And as well, don't forget to tune in to the closing print at 3:30. Joel will be back on then. Let's see where the S&P futures are sitting at here. We're still down 0.5% at 41.59. We'll see where the day ends up. We're bouncing back up here. All right. Thanks for tuning in, everybody.
Take care. Thanks.